Most options buyers think time decay is their number one enemy in trading. But that is not the case, friends. Definitely, time decay plays an important role, but the number one enemy is something else in options buying. I will explain few simple example. By the way, this is the content from my new book Options Trading Made Simple. You can read this for more information. So basically what happens is, let's say you are introduced to options buying. Now you buy some option, maybe call option or put option. You buy at 50 rupees. Okay. Now first day it goes to 100 rupees. Now you close the trade at 100 rupees. You make 2x profit and you will be very, very happy. But what happens after that is it gives a small consolidation or pullback and then the price goes to 200. So you bought at 50 rupees, you closed at 100 rupees. Now the price went to 200 rupees, right? It gives lot of emotions, right? It brings lot of emotions in your mind. Okay. So this is the first day. The second day. So what happens is once again you buy something similar at 50 rupees, the price comes to 100 rupees. Now, because of the previous day experience, instead of booking at 100 rupees, you hold the trade with original stop loss. Maybe the original stop loss is 20 rupees or 30 rupees. So you hold the trade with your original stop loss. Now, in this case, the price comes back and hits your stop loss. Once again, you get lot of emotions in your mind, right? Now the third day, because you have these two experiences in your mind, right, stored in your subconscious mind. Now the third day, once again you buy similar options at 50 rupees. Now the price goes to 100 rupees. Now because of the first now the prior 2 days experience, instead of closing it or instead of holding with original stop loss, you push the stop loss, okay, from maybe 20 rupees or 30 rupees to 90 rupees and you hold the trade. In this case, what happens is the price comes back, hits your stop loss and then it goes to 200 rupees. Now once again you get lot of emotions, right? Even if you hold the trade with original stop loss, it will hit the stop loss. Once again, if you trial the stop loss, it will bring emotions. Even if you book at 100, it will bring emotions, right? You will get a lot of confusion because of this, right? In this confusion, you go to the fourth day. Now you buy at 50 rupees, the options premium goes to 100 rupees. Now you hold the trade without any stop loss. You don't keep a stop loss at 90, you don't keep a stop loss at 50, you don't keep a stop loss at 20 rupees or 30 rupees because you think it will go up at any point of time. Now the market plays its trick here. It comes back and the premium becomes zero and you lose the entire money. Now you start blaming people like big players took the money, big players, because of the big players action you lost the money, or time decay is the number one culprit. Everything, it goes on like this, right? But the missed trick, what you have missed is time decay is not the number one enemy for options buyers. You don't know where to exit. That is the number one enemy for options buyers. I will repeat it once again, friends. Time decay is not the number one enemy in options buying. Where to exit your trade is the number one enemy in options buying. In option selling, let's say you sold at 20 rupees. You have a target, right? It becomes zero. That is your target. You have a clear, defined target for option selling. If you sold at 50 rupees, zero is the target. Irrespective of the price you sold in option selling, zero is your target. The target is clearly defined in option selling. When it comes to options buying, the target is not clearly defined, right? If you bought at 50, it can go to 100, it can go to 150, it can go to 200, it can go to 1000 as well, right? So this is where clarity is very, very important. So I've explained many these kind of very strange and not known topics for options buyers in this book. So to know more information, you can read this book. Now in this video, I will also explain the in detail aspects of options buying, in detail aspects of options trading, and how to make good profits in options trading. First, you need to understand one thing: option moneyness, ITM, OTM, and ATM. Many options trader think it's very simple. They don't have to complicate it and they go for OTM, right? Especially options buyers. But that is not the case, friends, because you need to understand one thing. Time decay works very fast in OTM, moderate in ATM, less in ITM. So if you are an option buyer, if you want to take only option buying trades, then you should not go for OTM, you should go for ITM, okay, one leg ITM or two leg ITM, because the impact of time decay is very very less in ITM. Okay, if you can't go for ITM for any reason, maybe a higher premium or whatever it may be, then you should go for ATM at the max. You should not go for OTM because the impact of time decay is very very high with OTM. Okay, now if you are an option seller, you can go for OTM. Definitely should go for OTM because ITM sensitivity for time decays and directional is very very high. So you should not go for ITM if you are an option seller. Okay, you should only go for OTM. Once again, if you have any constraints, you can at the max you can go for ATM, but definitely not ITM if you are an option seller. So simple. If you are an options buyer, go for ITM. If you're an option seller, go for OTM. Okay, that is the basic rule. Now the options. Okay, so you need to understand couple of things, friends. In India, we have weekly options and monthly options now. So weekly options, making money with weekly options buying is very very tricky, very very difficult, and requires a hell lot of skills, challenges as well. So I suggest, if you are an option seller, you can go for weekly options because the time decay will be very very fast. But if you are an options buyer, I suggest to go for monthly options, okay, instead of going weekly options, because time decay works very very fast with weekly options. So I suggest to go with monthly options if you are an options buyer. Now uh, going with monthly options again will not guarantee the result, okay, because going with monthly options with indexes like Nifty or Bank Nifty alone will not guarantee the good results, because uh, Nifty or Bank Nifty, they move very very less, right? Because very rarely it gives more than 1% move. For example, if you check Nifty here, if I check Nifty here, I will go to daily charts instead of 50-minute. See here, this is the day it moved around 1.02%, right? So if you compare to this, all these days it is less than 1% move. Again, here it is 1% move, right? Here it is 1% move, more than 1% move. So the Nifty gives this kind of trending moves very, very rarely. 20% of the time it gives only trending moves, and 80% of the time it gives sideways move, right, or less than 1% move. So if you are an options buyer, even in monthly options and Nifty or Bank Nifty, so you will not be able to make more profits, because options buying is all about catching the direction and momentum, right? But when the Nifty itself gives only 20% of the trending moves overall, you will not be able to make profits, right? So that is the reason I suggest this. Okay, see here, you should go for high beta stocks. Basically you need to understand these three things. Okay, high beta stocks, what are high beta stocks, what is options buying, why options buying, and then intraday strategy. I'm going to cover these three things in detail now. So what are high beta stocks? So high beta stocks are very very simple, friends. They come with greater volatility compared to the Nifty or Bank Nifty. Okay, so basically, if Nifty moves 1%, this high beta stocks will move 3%, 4%, or 5%, definitely more than 1%. So that is why it is called as high beta stocks. So if you look at some example, let's say on this particular day, Nifty moved 0.47%, right? See here, Nifty moved only 0.47%. But if you see here, these are the stocks which moved more than 0.47%, right? So most of them are high beta stocks. So you can also check the recent example. See here, for example, Nifty moved 1.0, 1.02% yesterday. But if you look at this, okay, all these are all high beta stocks. Axis Bank is an high beta stock. Maruti Suzuki is an high beta stock. Bajaj Finance is an high beta stocks. So okay, these are all the high beta stocks. Okay. So basically, the advantage of high beta stocks is whenever you take a trade with monthly options, especially buying, if the Nifty moves 1%, these high beta stocks will move 2% and 3%. So you will make more profits compared to the Nifty. Let's say you bought monthly options in Nifty, you would have made some profit, right? Uh, you should have instead of that you should have bought some some call options in high beta stocks. You would have made more profits because these high beta stocks will give more movement, right? So that is the basic idea of high beta stocks. See here, these are all some of the examples of high beta stocks, mentioned by NSE itself. Okay, ACC, Arthur Industries, Adani. If you just Google it, you will get it. I will also share this link in the description. I will also share the description. I mean, the link of my new book, Options Trading Made Simple, in the description as well. So you can also check this. Okay. So in my personal opinion, so these are all the high beta stocks which I have observed over a period of time. So Titan is an high beta stock, very good high beta stocks. Reliance is an high beta stock. State Bank of India is an high beta stock. ICICI Bank, Axis Bank, Infosys, TCS, HDFC Bank, Bharti Airtel. So these are all very, very good high beta stocks. I've noticed this from my personal experience. Okay. See here, this is yesterday. For example, Nifty moved 1.02 or 6% yesterday, whereas Bajaj Finance moved over 5% yesterday, right? So these are all very good high beta stocks. Okay. Now, uh, if I go further here, this is on 15th Jan, Nifty moved only 0.07%, whereas Reliance moved, 0.6%. Okay. So now the question is, why options buying? See, friends, I'm not suggesting only option buying is the way to make money. Basically, I have seen people who make money with option selling, who make money with options buying, who make money with different option strategies. So it's all about an individual and how he takes the trade based on different market condition. It is also possible to make money with options buying, but you should have a complete clarity, right? So basically, options buying is all about catching a directional momentum move. So in that case, you should take the trade whenever there is a higher possibility of market showing the momentum. That is one thing, and the second thing is you should go with high beta stocks. So whenever you go with high beta stocks, there is a high possibility of making more profits, right? So now the question is, why options buying? Okay, so the reason is very, very simple, friends. So option selling demands more capital, right? Some people might have the more capital, but maybe not everyone will have the huge capital, right? Beginners, especially beginners or intermediate level traders, they might have very small capital, so they will not be able to make option selling, right? So for them, options buying is beneficial, and spikes are dangerous for option selling. Nowadays we have observed spikes in Nifty and Bank Nifty, Fin Nifty in last few months. So you don't have to worry about spikes in options buying if it are kept a stop loss, or in the worst scenario it will become zero, right? Whereas in option selling the losses are unlimited, whereas in options buying the losses are not unlimited because it can go up to zero, right? So for that is the reason options buying is also beneficial. And earlier we had a lot of weekly expiries, right? Nowadays we don't have a lot of weekly expiries. For them also, options buying is beneficial now. And the most important thing is, options buying is very simple and it is very easy to execute. So for all these reasons, options buying are beneficial. Now, As I said earlier, we don't trade Nifty or any other weekly options instrument because in weekly options, time decay is very, very fast, and most of the cases you end up making losses, right? So you should understand the game. So whenever you take a trade with high beta stocks, if Nifty moves 0.5%, high beta stocks move 1 to 3%. So you will make more profit, right? And especially when you do options buying, it enhances your results, right? Okay, so these are the advantages with monthly options buying. Now, do you think all this is sufficient? Definitely not, friends. And once again, even if you do all these things, there is a possibility of losing money. So that's why money management rule is very, very important. Now I will explain one simple intraday options buying system, and then you need to connect the dots. Okay, so now let's jump into one intraday trading system. So basically, I'm going to explain an intraday trading strategy now. So breakout is the wonderful strategy for options buying, because in options buying is all about catching a big momentum move. So usually breakout compared to any other trading types will give good momentum moves on one side, right? So that's why breakout trading technique is the wonderful trading technique for options buying. So basically, what we do is it is an intraday trading strategy. Okay, so this is an intraday trading strategy, and we do it in 50-minute time frame. Okay, so basically we open 50-minute time frame and we check for certain conditions. Okay, so that is one thing, and we do it only in high beta stocks. So basically, you can keep on observing two stocks, or you can use four stocks, or you can check six stocks, but don't check more than four to six stocks. Okay, so 50-minute time frame you can compare, you can keep observing four or six stocks. So right now I'm going to explain the strategy for one setup, so the same set of rules will also be applicable for all the charts. Okay, so basically what we do is we open 50-minute time frame. So let's say the market opened here. Okay, the market opened here, and this is the range formed in 1 hour. Let's say somewhere it market opened here, and this is the range formed in 1 hour. Okay, so now this is the 1 hour range. So here it is 9:15, here it is 10:15. So this is the range formed. So the strategy is, if it breaks on the upside, we will take a long trade. If it breaks on the downside, we will take a short trade. Okay, so this is the fundamental strategy. It is also called as open range breakout. So again, there are many rules with open range breakout. They say, some traders say we need to wait for 30 minutes, some traders say we need to wait for 50 minutes, some traders say we need to wait for 1 hour. So in this case, what we do is we are combining market profile with options buying. That's why in market profile, 1 hour range is called as initial balance range, IB range. So we'll wait for 1 hour range. So for example, in the Indian market condition, so this is 9:15 because the market opens at 9:15, and this is 10:15. Okay, so basically this is where after 1 hour range it ends here. Okay, now the question is, sometimes what happens is, let's say this is the 1 hour range. Okay, so this 1 hour range is already formed. Now sometimes what happens is price goes up like this, and it comes back, and it goes on like this. So if your intention is to take a long trade, whenever the price breaks the upside, it would have been a mistake, right? Because in this case, price would have been hit your stop loss it somewhere here, right? So similarly, sometimes what happens is, if this is 1 hour range, if your plan is to take a short trade whenever the price breaks downside, sometimes it does like this. Okay, it breaks and it goes up again, it goes up like this. Okay, so if your plan is to take a short trade somewhere here, you would have lost money. So that's why I suggest a simple filter to avoid this. So first what I do is, I will go to 50-minute time frame in different stocks. I will show these false breakouts, and then I will explain a filter, and then I will show some of the examples because of the filter, it would have avoided these false moves. Okay, so now I will go to some of the example. First, I will go to 50-minute time frame. As I discussed earlier, we only use 50-minute time frame. Okay, so now I will go through with some of the examples. Uh, okay, this is 50-minute time frame. This is the beginning of the market. This is the closer of the market. So first four candle represents the 1 hour, that is IB range. So let me go through with some of the examples. I'm not unable to find the right examples at this point of time. Uh, 1, 2, 3, 4. I'll go to some other stock actually. Okay, this is here. Okay, for example, see here, 1, 2, 3, 4. This four candle represents the IB range. So let's say this is the upper range of the IB range, 1 hour range. This is the lower range of the 1 hour range. Okay, in this particular, I'm talking about in this particular day. So if your plan is to take a long trade whenever the price breaks above this upper line, so if you have taken a long trade, it would have hit your stop loss, right? That's what I was trying to say. So now I'll go to some other stocks as well. For example, I'll go to Reliance. If I go to Reliance, uh, the same thing happened here, right? For example, this is the beginning of the 1 hour range. This is the end of the 1 hour range, higher and lower, right? So if your plan is to take a long trade whenever the price breaks the higher side, see here, it would have hit your stop loss and it would have, I mean, it would have triggered your entry and it would have triggered your stop loss as well, right? So you will get plenty of examples. Okay, for example, in this case also, right, you would have taken the trade because this is the fourth candle, this is the high of the 1 hour range. You would have taken a trade, it would have hit your stop loss, right? So this is one more example, right? And you will get many examples in the market. If you follow the ORB concept as it is, see here, it is not there. See here, it is there, 1 2 3 4. This is the first 1 hour high, right? So if your plan is to take a long trade, it would have hit your long trade here, and then it would hit your stop loss, right? Okay, so now the filter I was talking about is very simple, friends. So what we do is, let's say this is 1 hour range. So we will keep on observing the 50-minute time frame itself. Okay, that is number one. And whenever the upside, let's say I'm talking about upside now, if the candle closes above this upper line, and if the selling wick is less than 20%, okay, so don't go by the rule as it is, but it should be, the selling wick should be small. So what this indicates is the absence of selling forces during the breakout candle. That's very important, friends. So the selling force should be absent or minimal during the breakout. Okay, so whenever this candle forms, we will take the long trade above the high of this breakout candle. Okay, so we will take the entry for our long trade above the high, little high. Maybe you can add 0.1% or 0.2% filter. So we will take a long trade above the high of this candle, and our stop loss will be below the low of this candle. Okay. So this is for a long trade. If your aim is to take a long trade, you should follow this filter. If your aim is to take a short trade, we need to wait for the candle close below the low of the 1 hour range, and this buying wick should be very small. It should be less than 20% compared to the entire body. This wick length should be less than 20% compared to the entire body. Okay, so whenever this forms, we will take a short trade just below the low of that breakdown candle. Okay, this is a short trade, and our stop loss will be above the high of the breakdown candle. Okay, so in this way you can take the trade, and in this way there is a high possibility of catching breakout or breakdown moves. So whenever you follow this filter, it also avoids 70 to 80% of the false moves which I explained just now. Okay, so now we will see some of the examples. Okay, so even with Reliance itself, you can see, for example, we'll expand a little bit, zoom in a little bit. 1 second. Okay. Okay, see here, the high of the 1 hour range in this case is, this is the high. Okay, sorry, this is the high. The 4 candle represents uh it's little bit. Okay, this candle high is the 1 hour high, and this candle low is this is the 1 hour low, right? See here, what happened in this case is, this selling week is more than 20%, right? So we don't take a long trade in this case, right? See, because of this, you would have avoided a failed trade, isn't it? So that's how this filter easily eliminates 70 to 80% of the false moves. So in this case, for example, in this case, this is the high of the 1 hour range. This is the low of the 1 hour range in this case, right? See here, the price broke above uh, the high, but the selling wick is very high, right? It is more than 20%. So we don't take a long trade here. Once again, it avoided the false trade, right? So in this case, for example, this is the high of the candle. Again, now in this case, the length of the selling wick is less than 20% of the candle, right? So we would have taken a long trade, little bit profit, right? So again, in this case, this is the high and this is the low. For example, I will bring these lines here. So in this particular day, this is the high, this is the low. It there is a buying week. We don't take the trade anyway. The market or price, they didn't move much here, so it is fine. There is, here once again we would have avoided a false trade right here, right? So here, this is the 1 hour high, price moved here. It is, more than 20% of the selling wick, so we don't take the trade. Also, anyway, price didn't trade above the high of this breakout candle, so we don't take the trade. We would have avoided the failed trade, right? I will probably I will go to something else as well. For example, I go to Bajaj Finance. If I go to Bajaj Finance, here 1 2 3 4, this is the high of the breakout candle in this particular day, and this is the low of the 1 hour range. See, in this case, price broke with a very small selling wick. Our long trade entry will come above the high of this candle here, somewhere here. Stop loss is somewhere here. The price moved very much, right? Very good profit on this particular day. I can go on and on and on explaining this concept. See here also, right? For example, this is 1 2 3 4. This is the high of the 1 hour range. This is the low, right? This candle contains, less than 20% of the wick. You would have taken a long trade here. Anyway, the price came back here, but that's where the partial exit comes into the picture. One can book profits for 1:2 or 1:3 risk reward trade whenever they are doing options buying, because you don't get the clarity till where the price will go, right? But one thing I can confidently say is, whenever you use this filter, it avoids more than 70-80% of the failed trades in most of the cases. See, for example, it's not loading. I will go to something else. For example, if I go to Titan, Titan is another high beta stocks in India, and it gives very good move compared to Nifty. If Nifty moves 1%, so most cases or most of the days, Titan gives a very good move. It is more than 1% or 1.5%. So right now I am near a beach. Network issues are there. Wi-Fi is not very strong, so it is taking more time to load. I will check the Bajaj Finance itself. See here, in this case, for example, this is the low of the 1 hour range. See here, this candle broke with a small buying wick, right? Below the low, we'll take a short trade. It would have made a profit, right? Once again, there is a profit here. Okay. So my point is, don't worry about the profit, friends. Look at the filter. Filter easily avoids many unnecessary trades. Okay, that is the advantage of the filter. Okay, for example, uh, here the trade is not there because it didn't trade it below the low. Uh, See here, we don't take the trade here because lot of buying weeks. Anyway, price didn't move much. See here, we would have taken a trade here, right? This is the low of the 1 hour range. This is the high of the 1 hour range in this case. See, in this case, the buying week is very less, right? So we'll take a short trade below the low of this candle, keeping a stop loss above the high of this candle. That is in options buying. So basically we buy put options somewhere the near the strike price or one leg ITM. Okay. See, you would have made very good profit on this particular day, right? So I will recap all the points which I'm discussed till now, friends. So number one, if you are doing options buying, we don't do it in weekly options buying, we do it in monthly options buying. Okay, that is number one point. And the number second point is, so if you are doing options buying, we don't do it in Nifty or Bank Nifty, but we do it in stocks. Okay, that is number two. And again, in number two itself, we don't do it in all the stocks. We do it in only the high beta selected stocks. Okay, you pick any four or any six high beta stocks. You keep on observing the stocks. Whenever you find this kind of setup, you can take the trade. Okay, that is number two. And number third is, if you are an options buyer, you should do ITM, one leg ITM. Okay, let's say for example 9,000 you got a trade. So for example, market is going downside. So in this case, you can buy 9,000 or 9,050 or 9,100 put option, one leg ITM put option. So whenever you do that, the impact of time decay is very less. Okay, that's one thing. So people can use the same setup for option selling as well, but again, option selling, it's little risky in stocks because sometimes liquidity issues will be there for option selling. And if you don't keep a stop loss or if you don't go for hedging, you might end up losing more money if you're an option seller. Okay, so but if you are disciplined enough, you can use the same concept for option selling as well. Okay, so to recall all the points, if you're an options buyer, we don't do it in weekly options, we do it in monthly options. We don't do it in Nifty or Bank Nifty or indices, we do it in high beta stocks only. And number three, we don't buy OTM options, we buy preferably ITM option, one leg ITM option, or ATM option or at the money option. Okay, so and the most important point, number one enemy for options buyers is not the time decay, it is where to exit. Okay, when you buy at 100, you don't know whether it will go to 200, 300, 500,000 rupees, right? So nobody can predict it. So what you can do is, you should make a proper exit rule. Let's say you buy it 100, I'm going to book the profits for 50% of the position at 200 or 1:2 risk reward, and carry remaining the 50% of the position at entry price as stop loss. Let's say you bought it at 100 rupees. Now you book profit at 200 for 50% of the position. Now your original stop loss is 50 rupees. Now you trial that 50 rupees stop loss to 100 rupees. That's where you entry price, right? So, and you carry till the end of the day to make more profits for the remaining 50% of the position. Okay, so you should make a rule like this, because many days market will go up like 500,000, chances are there, right? So whenever you make a rule like this, even if the market comes back, you make a profit for 50% of the position. If it goes, if it blasts on the upside, at least you make a profit for the remaining 50% of the position, right? So this is where you can overcome and fight the number one enemy for options buying. Okay, I hope this video is really helpful, friends. I've explained these kind of concepts in detail in my new book, Options Trading Made Simple. It's very simple. You can buy the book, the link is in the description. And I've explained many strategies like this in this in this book. Now you can buy it, read it, and feel free to reach me if you need any clarification or if you have any feedback related to the book. I hope this video is really helpful, friends. We will see you with another video with another useful content. Until then, thank you. See you. Bye bye.